Good morning, everyone. My name is Josip Kasik. Today is October 11th. Welcome to Trading Options with Options at TradeActive platform. My contacts are right here. If you want to email me about any questions that you have about this particular session. Also, another way to contact me is simply that you go to our website. I always post the notes from everything that we're doing right here at trading with unfilledorders.com/Josip. And if you scroll it down here, you would see the previous sessions that we did, bear put spread, bull put spread. You go down, you see the previous sessions. That's a good way to see me. Also, take a moment to read the disclaimer because we are not financial advisors. We do not provide any financial advice. Everything is for educational purposes only. Even if you need to stop it, that's fine. So also in the chat box, if you can type in that you can hear me, that would be wonderful. So without any other announcement, I can jump in a big picture, which is explanation of what is actually going on, and then we're gonna look for the right trades. So if you can just confirm that we're good. Mark, thank you very much for confirming this. So we have a lot to cover because I really want to find the right trades, not just any trades. And in order to do that, we're gonna first look at the big picture. So let's start with the VIX first. So VIX is volatility indexed, and as you can see here, I'm going to just change it quickly to the daily. That the low of the VIX is a 19, and the high is pretty much where we are. 34 is the highest. We are now 32. So the simple concept: if the VIX is low 19 and a high is now 33, then being a seller makes more sense. So let me now put this back inside the agenda here, because you see the big picture is something that you should do every day, so you kind of get the feel for it, so you know what it is. So if I'm going to be a seller, I'm already kind of considering maybe a bear call spread versus a bear put spread, because bear put spread is a debit trade, and debit trade should be done when options are inexpensive. But due to the facts that the VIX has elevated pretty high, and I think it makes sense that we're going to be considering the bear call spreads. However, that's not all about the big picture. We can look at monthly just for a few seconds and kind of get the feel what the four majors are doing, because looking at the daily right now, it's not going to do the trick. So as you recall last time, we are looking, like where are these particular levels from the beginning of the year. So we had a January here, we had the low in February, and I said, well, that low in February has been pierced, and we have a new low which was created way in June, and we try to hold about that June low, or let's say here on the Dow Jones Industrial Average ETF, and we failed hard in September, and now this month is not over yet. But you see, every time when we poke the head, as if somebody comes and smacks us right back down. So be aware of it. This is a picture on the Dow. It's not that different on S&P 500. So on S&P 500, also moving that February low to the June low, and look at it. We are virtually right now ready to test the September low and go even lower. So maybe next session I'll be moving from a June low to September low. But wait, let's not make a judgment because we didn't look at the wild beast, which is a Russell. The Russell February low has moved here to June low, and as you can see, it hasn't been tested neither in September nor in October, which means that the small caps, or what I like to call the middle class America, is still holding on enthusiasm, and maybe there is a hope that this downtrend that we are seeing that has been in existence ever since basically the high of the January, high of the December actually, is still intact. So maybe we will at one point burst above it. But the Russell is going to be the one who's going to be leading us in that case. Last one, but not the least important, is the technology sector. So I'm moving the February down here to the February low down here to the June. And as you can see, it doesn't look good for technology. And what I was thinking to do today, when I jump into the looking for a trades, I was actually thinking to look at the two particular things, M&I. And M&I is actually Microsoft, and I also want to consider another biggie, which is Amazon. So if I'm going to be looking at the bearish trades as of now, probably the best bet would be to look at Microsoft and Amazon. But anyway, let's just now go back to the little bit more studying, which I think it's always helpful before we commit ourselves to any bigger decision. So I have here dailies that I have created as a workspace, and I want to now on the dailies kind of point out to you that not all four markets are currently showing the same level of weakness. I have shown you the Nasdaq, but you will notice right here on a Dow on a daily, we're not sitting at the low. That's significant to know. That's significant to know because when you're looking right here, either of these lows on a QQQ, which is a proxy or a ETF that tracks a Nasdaq, you would see that we have breaking up this low, then we have breaking up the September low, and now we are on a Nasdaq trading even below that. But that doesn't mean that all other markets are doing the same thing. You see, as I pointed out to you, on a Russell, we're still up below this June low. We're still up uh, below the September low. And last but not least important is the S&P, which is a mother of all products. And you would notice that we definitely pierce to the June low. We have touched September low. But as of now, as of this very second, we're bouncing off that level. And I think at this point it would be appropriate if I bring the FinViz and just show you what the FinViz is doing. So now we are no longer looking at the monthly, we're no longer looking at the daily, we're now looking at today's price action. And as you can see, all of these markets, every one of these markets has gapped down this morning. So the dotted line represents previous day's close and where we opened. Previous day close and where we opened. Now notice in the morning today, all of these markets, hi Jeff, good to see you, have gapped down. But the one that is the strongest of them all is actually the Dow. And then it comes to what? The S&P 500. And you can simply observe that just by looking at the percentage. Don't look at the dollars because they don't mean anything in comparison to each other. Like this $98 up would be completely different story on the S&P 500, $98 up. So you should be looking at the percentages and be aware of it that I want to look at the Nasdaq because the Nasdaq is the weakest of the week. And if I scroll down here, uh, this is a map of the S&P 500, and this map of the S&P 500 represents all the sectors that go inside the S&P 500. You would see two of them that are completely in red. One would be financial and one would be technology. And I mentioned to you that I like to trade M and A, and M stands for a Microsoft right here, and A stands for Apple right here. But before I do that, I have also open up the workspace here, Forex Factor, because it's very important for me to show you what is happening today in terms of the economic announcements. And when you click the this particular icon right here, which represents the little panel, be aware of it that you can alter what you want to look at here. So when you click this particular icon, you would get the yellow that is not very important. It's a low impact. So if I uncheck the low impact and then apply it, and notice in terms of the currency, I uncheck all the currencies, um, and then I close this. There was just uh, one of the Fed heads was speaking today, and this is all that it was. But if I move to tomorrow, you're going to have two red flag events. And the one red flag event that you have is price producing indexed, and expect tomorrow there's going to be a gap. Then at 11 o'clock, one of the Fed heads is going to release the Federal Open Market Committee meetings, and we're going to be reading these meeting minutes, kind of gauging ourselves what is going to be in the future. So Wednesday, expect the gap either up or down. And in case you're not completely sure what is this price producing index, you can click here on the details. In one particular area that I like to point out to you from all of these things that I really think you should care. It's don't read all of these things. They don't matter. They don't matter. There's only one thing that really matters, in my opinion, is this one right here. And if you take a moment, you would notice it says, why would you as a trader care? Because it's a leading indicator of the inflation. So we have the PPI, and then we have another bombshell that comes up, not on Wednesday, but on Thursday. And that is the flip side of the PPI. That's a consumer index. So when you open that up again, please do the same thing. Do not bother reading all this information. It's irrelevant to you. It's completely not something that you should be wasting your time. But look at here. Why would anybody care about the CPI? Because it's a consumer price index, and it is a major overall indication about inflation. So be aware of it. These two things are coming up, but that doesn't mean that the rest of the week doesn't have anything else. So on Friday, do we have another red flag event? Yes, we do. And these are core retail sales. So be aware of it, the way everything is connected with the inventory. If we are about to have a huge inflation, maybe producers won't be producing too much of the stuff, and then consumers won't be buying that much, and all of a sudden the retail sales are not going to do good. Now of course you can see all these things simply by clicking on the calendar and lining it up, but I like to show it to you one by one. So be aware, there's a lot of negative things coming up Wednesday, Thursday, Friday. So there are going to be definitely some gaps up, and we need to be prepared to know what we're going to do. So do not get attached to your long trades just because today the market is up. You should be at the point that you can simply reverse them, and we're going to be now looking at finding not any kind of trades, but finding the right trades. And one of the best ways to do that is to utilize the top Trade Active Option Planner. And the way how I like to do that is I like to bring in the option value map. So what I'm going to do right now, I'm going to go here to my setting for daily on my Microsoft. And when I'm here on a daily, I'm going to observe what is going on. So obviously we have a 9-day exponential moving average that's been going down. According to the standard deviation, we can have, normally, statistically speaking, 5 down days. we are currently 2 out of those 5 down days. But what is interesting that implied volatility on the calls is slightly higher than implied volatility on the puts. Hint, hint, hint. Therefore, I think it's better for me to hit it with the calls. Now, I don't want to hit this blindly. I want to actually use the option value map, which is a proprietary tool. And the way how you can insert that on this chart is simply to right click. And then when you go over here where it says add study, you will notice that there's two of them that are proprietary tools. So the proprietary tool that is already plotted there is unfillorders.com, which is already patented. And then the second one that is patented out of all of these that exist, right here that are just regular tools that you can find on any other platform, um, are present, but be aware of it. We're going to be clicking at the option value map. So now when I click on the option value map, I want to look at the very first expiration that is monthly, and that is going to be October. So that's going to be October. So I'm going to apply this and I'm going to agree with it. And now I have October. And what I'm going to do here for a moment, just to kind of line this up, I'm going to show it to you here on the top side that you have a huge, huge activity on option value map. But if you keep on clicking here, you're going to get to the point that you can actually switch this to the open interest, right? So this is now the open interest activity for the October 21st, which obviously you can see right here, October 21st. And you would see that we have an activity taking place around this red UFO. So if you keep on clicking right here, you're going to notice a huge blue represents the calls, red represents the puts. The huge activity of the 230 calls, which are currently higher than a current price. So what I'm considering right now, and I'm going to start typing here in this document, is the bear call spread obviously on the Microsoft. So if I'm going to hit the bear call spread on the Microsoft, I want to make sure that you're aware of it, that the Microsoft is currently trading. Let me just pull this up, when I bring in my trading platform here. I'm gonna type in the trading platform and gonna populate. So 230 would be my quote unquote area of the focus. And this area of the focus that I have, just grab this and drag it down inside inside the thing and continue with analysis here. So 230 is area of a focus that I'm going to be selling. I'm going to be selling 230 right here. So when I go into the option chain, so I'm going here, pulling up the option chain for a month of October on the Microsoft, bearish bet, bear call spread, one more time, bearish spread, bear call spread, edit the spread. So it populates the 230, but it populates the 230 as a buy. I don't want a 230 as a buy because obviously we are sitting currently at 226 and some change. I want to sell 230 and then I want to buy the higher one. And I think it would make sense if we buy the 235. So one thing that I'm going to point out to you, notice that by default setting, this has actually selected for me November, and that's not what I want. But if I were about to do the November, just to have a point of comparison, how much premium would I be getting? So for a November, for a November on a bear call spread right here, it shows that I would get 200 and basically $35 of the premium, while I would be risking for a November. Let me just enlarge this here. 265. So I just want to have this as a point of comparison here, so you would have it here once when I start comparing. Do I want to hit this with the November, or do I want to hit it with the September? So if I have here two bear call spreads, so we're talking about the bear call spread is my trade that I want to do for October versus November. So if I have a November trade here and I dump it in, it shows that I can get the credit. So I'm getting the credit of the 235. But the problem is that is expiring in November, and we have election. We're going to have a lot of volatility. What about if all of a sudden uh, between now and election, or between October and November, they kind of make the things look good, and I might have a winning October trade, but I have a losing bear call for November. So I kind of don't want to go to November a little bit way too far. So what I'm going to do right now, I'm going to edit the spread without altering these strike prices. These strike prices are still to my liking. I still like them as a 235 and 230. I just don't like the expiration. So I'm going to switch it to the October, and October 21st is the monthly expiration, because the monthly expirations, they always come on the third Friday. So I'm going to now click OK, and I would expect a lesser of the credit that I'm going to be getting. So again, the same thing is showing me right here that I'm getting, and I'm going to just take a snapshot over here of this particular area. So you would be able to compare it side by side and make a decision, is this acceptable to you or not. So we're going to be getting the credit of only $189. And of course, our risk is going to be significantly higher. We're going to be risking 311, right? Well, in that case, you would say, oh, but my maximum risk of the 265 is lesser. Yes, but you have this event that is a midterm election that's coming up that might cause the volatility to either drop or to happen anything else. So I kind of feel more comfortable placing the trade on a 135. So let me now just go quickly and execute this trade here on this platform, and see how well so everybody sees the platform. I'm going to be switching here to the Microsoft as a product. 227. So since I have spoken, it has rallied up from 226. So it was down at 224. So that's mean market is really ripping. So since I have shown to you what the market has been doing, the gap on the S&P had been almost completely filled. So we have this sliver. Let me just draw this line, not to be wiggly, but to be a little bit more clear. Only this sliver left, and of course the Nasdaq, but Dow is off to the races. So we are now looking that the Microsoft is strengthening, but because this is a monthly trade, not daily trade, we shouldn't worry too much about it. Now, this is what I have seen as a pattern over the last several weeks, that we rallied up to the gap, we fill this gap, and after we fill this gap on the Nasdaq as well, we actually end up going where, let me just change the color, down. So I wouldn't be surprised if Nasdaq fills the gap, S&P has already filled the gap, has gone higher. Of course, the Dow is a beast, has gone even lower, and we stop going higher, because the computer, the algorithm kicked in just to fill the gap, and after that, it's nothing really changes on the bigger picture. Still, the technology is suffering because of the higher interest rate. Financials are in trouble, and we are just about ready to go to earnings season of the financials, which is going to kick off um, very interesting volatility. So we're still going to proceed with our trading. So obviously, we need to add a little bit more strike prices. So we're considering to do 230, 235 bear call spread. And if you want to see the activity, I'm going to switch here on the volume. You would see, of course, the volume and open interest are the two that I populated here. But just for a second, I'm going to get rid of the open interest just to show you the huge activity that has taken place on both of these products today. 2,446 contracts are hedged with 2,226 contracts. And we were able to see that on our Trade Active earlier. Let me just float this for a second. Um, when we were looking at the chart, and it was just poking our eyes, and we were like, okay, so this is definitely something that we know that we're gonna do because we have this huge activity right here on 230. So I have no regrets uh, picking that particular strike price because it is a correct strike price for me to do the execution. So I'm clicking on the bid. I'm selling vertical just a one time. When the vertical populates right here, I'm gonna fire the trade in, and I want to make sure that oh, now it's only $1. Wow, let's see if I can get to 107, because the more I talk, the more this thing changes from what it is. So 107, they're looking at it, they don't want to give it to me because, as you remember, over here they want to give me only one. So I would need to tweak it down to, let's say, 105, which is still 5 cents higher than the natural. See if I'm gonna get filled, and they fill me at the 105. If this was a real trade, which is not, because obviously I'm here in a paper trading account, and you can all see that right here. It shows simulated trade. This 2448, if this was a real trade, would become a 9. It would instantly fill a 9. But because it's a paper trade, it hasn't moved unless there's a real trade that somebody takes right now and this populates by 9. But this is the first trade that I placed. So now what I would like to do next, I would now like to look at the same trade, bear call spread, that makes money only if the market goes down, on Amazon. And I'm going to apply the same logic. I'm going to leave my option value map right here, but I'm going to just change Amazon here. So I'm changing to Amazon right here, and I'm approaching it in the same way. I'm looking here at this red UFO, and I'm seeing this huge activity on Amazon, and it is actually at the 115. So I like 115 as a possible bear call spread. So just like I have created the document a second ago for for the Microsoft, I'm gonna create the same document now for the Amazon. So I'm gonna be comparing the two things. I'm gonna be comparing for Amazon October with November. October with November. So same steps. October is going to give me less premium than in November. November is going to give me more premium. But what I really want to make sure that you understand this whole thing is that you're taking more risk in November because of these uncertainties versus meaning the midterm election in the United States, than what you are doing when you are selecting the October. But I need the information for November. It's not a waste of time because everything exists relative to something else. Quote of Albert Einstein. I need to have a default setting that I can measure whether or not it's for me worth to do something else. So I'm considering selling 115 on Amazon and buying the higher up, let's say 116. Okay, so buying 116 is gonna protect me just in case I'm wrong. Another reason why I wouldn't do that for November on Amazon, because that would be going into the Christmas with shopping and everything. So my trade for October on Amazon that is bearish might work out. But for November, due to everything else going on, including the Santa Claus rally, I may not even feel bearish anymore on Amazon. But I need this information for November to have the sense of the pricing. I need to have a sense of the pricing. And I'm clicking here on the risk graph. And once when I get the risk graph right here, I'm seeing it over here that they're giving me the nice premium for November in amount of, let me just enlarge this so you guys can see it better, of, well, I mean, this particular option goes in the 50 cents. So instead of risking the whole $100, I'm risking only 52.50, but they owe me 47.50 of the credit. Expect this to drop when I change this to October. Based on that, I'm going to decide whether or not I really want this trade or the one I will move to something else. But as of now, I like the way how the chart looks. I'm going to edit this to October. Again, it's going to be October 21st because obviously that's the monthly expiry. And now when I'm done with it, I'm just simply clicking here, give me the risk graph for this thing. And it's showing me that that's 41 cents. So this particular spread is at 41 cents. So let me take a picture of this right here. So you would see that's 41 cents. How did I arrive to that conclusion? I arrived to that conclusion. Oh, now since I took a snapshot, it changed. So anyway, they give me $40 credit while I'm risking $60. Okay, now this is nice in the theory, but by the time I pull up my Thinkorswim platform and place it, the numbers might be different. So I'll try to cut uh, all the stock to bare minimum so I can do this faster and um, not get a different premium just because it took too many minutes to talk in between. So we're currently at 11273. So we're having like about $2.25 of the breathing room if we are selling the 115 and buying 116 for October. So I'm clicking sell vertical. They're going to automatically populate the 116, so there's not much that I need to change. Okay, I didn't talk too much. I get 42 cents if I'm lucky, and I got 42 cents. So that's even better than what I have. So this particular trade I actually like more than the Microsoft. So what I'm going to do with this particular trade, I'm going to put it in my document here so I can elaborate a little bit more with you about it and walk it slowly, explain it, and not rush it at all. So we have two trades. We have a Microsoft on the top and we have Amazon on the bottom. Obviously, the one that I like the most is Amazon. So we paid 282, which is a nice number, and we had to give back 240 in order to keep the 42 cents. So knowing this, let me just now enter this information right here. when I go into the edit, it was a mid price, but I'm going to put what is it really that I got filled. So I got filled for 240 of the money that wasn't mine, but I was able to get the 282 from the market maker. And that's why it shows that I'm risking pretty much more. This whole area, it's in red. Let me make this in a red because this is where my $58 lost is. If by any chance the price action of the Amazon start going higher than 116, I cannot lose more than what I have marked here as a 58. That's the beauty of it. And I'm going to take a snapshot of this because I'm so conscious that I need to actually put all that information in that Word document, not the Word document, into that Excel sheet after the session. And whoever watches this on the YouTube later on will know that we arrive at the right trades. And the keyword is not just a trade, but the right trades by looking at all these right steps. Now let's talk about the profitability. My profitability, and it would be appropriate if I change this into green, is only $42. And that $42 is fixed if the price stays below the 115. Even if it goes down to whatever, the 105, I cannot make more than what is fixed. Now, could I do something creative? And I bet that, Mark got even better filled on the Microsoft than I did. That's wonderful. Mark, could you type in what did you get filled on the Amazon? Because I kind of have a more personal preference to Amazon because I'm now considering revisiting Amazon one more time. And just to shock you, I can use a Finviz to make my decision on Amazon off the daily, just off the daily. So let's see what the market is doing. Yep, as I mentioned to you, it's just about ready to fill the gap, and then we'll see what is going to happen. I would expect now then target has been hit, and many of the orders are going to be exiting at the high. Okay, so take a look. Amazon could go down lower to the June low. Isn't that interesting? On Amazon, the June lows are down around 100 and 102. So what I'm kind of entertaining, and this is just my entertainment, you don't need to agree with me on this at all. Uh, I'm thinking maybe I can use the capital that I have gotten from bear call spread to finance the debit spread if the institutions are there. If I'm not the only one player, I will do this trade. But if I see I'm the only one kind of entertaining this possibility and nobody else is there, then I'm not going to do it. So let's now go back to the chart and look at it. What is happening down here below? So I would need to squish this to see what is happening. You know what? At this point, I'm going to remove the study that I have here. And the reason why I want to remove the study because I want to look at the weekly. So I would see the weekly UFO is exactly what I was mentioning to you. It's around the level 100. There's a lot of buy orders, but I don't want a level 100. I want to target this level, which is more like a 102 and 100. Yeah, so maybe buying the 102 and then aiming the 100. And again, there's multiple ways how you can arrive to the conclusion whether or not you want to do this. One thing that you can do is simply ask for more strike prices on whatever the platform you're using. So let's say I'm going to ask 33 strike prices here so I can see it. So you would see the intrinsic value is on a put side 0000. But when you get to that area that I was talking to you, all of a sudden this is poking your eyes, and because I'm dealing with puts, I'm going to just change it into red. This is poking your eyes. How come there's all of a sudden so much activity around this area of the 105 and the 100? How much would it really cost for me just to buy one of these 105 and a 100? Okay, so I'm considering buying 105 and selling the 100. It would cost me only 66 cents, 68. Now I just changed to 68. Okay, knowing this information, what I can do next, now that I know this information, what I can do next, I can now entertain the possibility, okay, of enhancing my bear call performance by financing the bear out of the money put spread on the Amazon. So the bear put spread, okay, is a strategy that I bet a lot of people simply don't understand, because it is different than a bear call spread. Bear call spread is something that you can simply place it and almost like forget about it. Bear put spread, you got to have an exit. So if we are currently sitting here on Amazon, let me just get exact price at 112.90. Okay, if we are sitting on Amazon on the 112.90, and let's say we don't even hit my target on a bear put spread. So let's say my target is anywhere between a 102. Well, let's just say 102. Let's not complicate. 102. And I have here a bear call spread in which I bought, which is currently out of the money, 102 put. And I sold to open, which is even more out of the money, 100 put. Okay, so both of these puts are out of the money, and this bear put actually is a debit of about, I don't know, 68 cents. 68 cents. I'm sorry, I think I was wrong, because they didn't have the price of 102. That's right. They only had the price of the 105. Let's just fire this straight in. I mean, after all, this is a paper trading account. I already gave a disclaimer. 66 cents was what was quoted. This says a 67. Let's see when I'm going to get filled. I got filled for 67. Look at the beautiful thing. For this, my profitability is going to be $4.33 if this really goes down. But I don't believe that Amazon is going to be that weak and it's going to go below the 100. Maybe it will, but that doesn't matter. As long as my 67, let's say, doubles. If my 67 doubles to, like, let's say 130, I'm going to be very happy. I'm going to be very happy about it. So what I'm planning here, ladies and gentlemen, is very simple. I'm planning a $5. This is a bear put spread that is 5 points wide. That is risking. We got filled 67 cents with the maximum profit. And how do we calculate the maximum profit? Well, you take that 5, you subtract the 67, and you get the 433. This for me is a good trade. However, be aware of it. It's not free. Why do I say that it's not free? Because it ate up $500 of the margin. You see that? Margin has been eaten up on Amazon. buying power effect is $500 because the difference between this and this exactly is what I wrote here. And let's make this into bold. $500. Never mind that I paid 67, right? Be aware of it. What I'm trying to say, the 67 can make me a profit, and let's make this into nice green of this. But I don't like paying the 67. So let's now give the so my target is still 102, which would be great because if we hit the 102, that's mean my 105 put when we are at 102 would be at least $3 in the money, at least $3 in the money. So let's give now. Thinkorswim calls this combo trade. So what do they mean by the combo trade? What they mean by the combo trade is that I have here October bear call, and over here I have October bear put. And of course we're talking about the Amazon, so I don't need to put any of these words. But over here my bear put is a debit of the 67 cents. And on the bear call, you'll remember how I got this nice round number of the 40. So over here I got the credit of 40. So net, I'm short. Okay. This combo, if I were about to do it, would still be a debit of the 27 cents. Debit of the 27 cents. So let's build this properly. And again, I'm gonna follow the steps in such a way that it would be very, very difficult for you to lose me. So I'm gonna start with something that we already have. We already have a bear call spread, and we already know the numbers, right? So we did the October, and specifically when we did the October 116 was my buy, and 115 was my sell. I got filled for a nice premium of the $282, but I had to give back $240. And I did not like that, but what I got was that 40 cents premium. Let me just alter this for 1 second because I think I mistyped it. So I'm going to just alter this 42 so I can have the number 40 there. Never mind what I got filled on my platform. What it matters here that you recognize that this is a 40 cents. So now what I'm doing here, I'm going to be editing, but this is no longer going to be the same spread. So when I add another option leg and another option leg, they're still going to be in October. But one is going to be the sold. And one that is going to be a sold is going to be a 100. And that 100, wow, I need to scroll all the way down here to get the 100. And this one that is here, 105. And let me just revisit here just for a second what I got. 120 with the 53. 120 was my purchase. My purchase was a 120, and 100 was 53 cents. So now when I click it, there's that difference of the 27 cents. So if you can observe here, I'm going to just walk you through this very, very slowly because we are fine with time. We don't need to get stressed out at all. We have time, 11 minutes. And explain that this 27 cents that I calculated, it's right here. So what we are doing here in this unknown trade, which is really a combo, if you want to know Josip term for it, but don't go out and say this in public because they they're not going to understand what you're talking about. Because is the bear put spread a vertical? Yes or no? Yes. Is the bear call spread also vertical? Yes. Are they both bearish? Yes. So if you want to lose a conversation at the cocktail party, just tell them you just opened some double bearish vertical on Amazon and see how quickly that person turns around and goes away. Mark, you got it 45. That's wonderful. That's even better than me. That's about the 3 cents extra that you have gotten, and your commission is what, still 65 cents, just like on my end is 65 cents. So you basically then have a free commission too. So this really works out good, you know. So what is the beauty of this double bearish vertical? It's financing, but can we have a variation? And this is the beauty that I want to show it to you. Right here, can I alter this particular area and sell two of these to bring in 80 cents? So think about it. If I would now do two of these same bear call spread, I would be then bringing the 80 cents, but my outlay of the capital would still be 67 cents. So in that case, I would be ahead of the game. I would be ahead of the game. And I'm going to go over here, edit the spread. And instead of saying one, I'm going to make it into two. And instead of buying one, I'm going to make it, but the lower one, I'm going to leave it. I'm going to leave it. And there it is. This is improvement. This is the beauty of our improvement. So on the top, we're talking about me being in debt. On the bottom, me being ahead by 13 cents. Now, disclaimer, disclaimer, disclaimer. Two bear call spreads mean over here, what do I have? $1. Okay? So I have a margin of the $100, just so I have it shown to you. Buying power effect is $100. What do you think my margin is going to be here? Correct answer is $200. But I don't mind risking $200 if I know that my bear put spread has this possibility of giving me more. Now, this is just theoretical. Be aware of it. My real target, if you want to know, this is a stock target right here. This is a stock target. My option target versus my bear put options target is simply to double my 67 cents to approximately $1.30. That's all that I want. Because if it's $1.30, I take it off. By then we're somewhere where around 102. And if you're at 102 and I have sold 115, don't worry about buying 116. That's useless. That's just something that I had to have as a hedge in case I'm wrong and market goes up. Mark, you're ahead of me. He already has fired it in. So let's build this beast. And be aware of it that I'm going to switch the accounts because I want to have two different accounts. So this is my margin account and I place these trades in, right? So I want to now go into my IRA account where I don't have any current trades open, so I can build this. Okay, so my first thing is that I'm buying this. Okay, for 64 cents. Okay, and it's a one contract. Okay. So now I tuck this away and I go up here to the 115, 116. And I again click. sell that. Now, the beauty of it that I'm going to be changing this. Now, as it changes, these numbers are going to change. So this goes up and this goes down. Okay? We're going to ask for 27 cents. Send it in. 1 Mississippi, 2 Mississippi, 3 Mississippi. Every time when I do this kind of trade, I have this vision of the good, bad, and ugly from that movie with Clint Eastwood. You know, when challenge is taking place between two major players and they are like staring at each other, and the camera zooms in on their eyes, and they probably have a cigarette in their mouth, and they're just about ready to pull up their pistols and shoot at each other. I have fired the trade in to the market maker, and the market maker is like, "Oh, so you wanted 27 cents?" You know, and then Clint Eastwood is on another end, you know, like just about ready to spit, you know, because he chews some tobacco, you know, and who's going to pull the first one? Now it's saying, "Oh, 29, none of this is real. None of this is real." Who's going to pull the first target? If this thing works out, 27 cents. But in reality, mathematical calculation is 13. Because what am I trying to do here? I'm trying to sell two bear call spreads to finance the 105. So this thing is so unrealistic according to what the real calculation is. So when I go over here and I replace it, you see where the real price should be? It's closer to 19. Closer to 19. So can I afford to drop my credit a little bit? Because I want to play with them. I'm going to go down by 2 cents and wait. 1 Mississippi, 2 Mississippi, 3 Mississippi, 4 Mississippi, so on and so forth. If they're not giving it to me, it doesn't matter what they're marking in here. This is a complex option with 4 legs but 6 contracts. Oh, you just lost me. Why is it 6 contracts? Because you have here double and you have here singles. So I would need to walk this down to 23. Look, in reality, this is supposed to give me 13 cents. So I'm starting here way up there. So Mark, I got filled on this one better than 23. They actually have given me what? 24. Wow. But you got it different. Yeah, you see, Mark, your thing is just a slightly little bit tweaked. Okay, we're just about to wrap up the session. Let me now review everything that we have done in this last hour. We have started first looking at the implied volatility, and we concluded that the implied volatility has a low of the 19 and a high of the 33. And this is kind of interesting because aren't we currently lifting? So if we are currently lifting on the market, and there it is, ladies and gentlemen, you can re-listen to my recording when I said when the gap fills, usually what happens? Algorithm targets kick in. And it doesn't matter the Dow broke to the new high, 250 points up. NASDAQ has filled the gap. Algos are done for a day. Don't force the trade right now, unless you're trading some iron condor sideways for the rest of the day. I mean, like what? You think this day is going to make a history books? S&P has moved 0.1.6%. You think that's going to be in the history books as October of 1929 when the market crashed, or even the one closer to our history, October of 1987, Black Friday? Yeah, this is a day that it's not going to live in infamy, like FDR said on December 7th of 1941. This is a non-event day because, ladies and gentlemen, we are waiting for core retail sales on Friday, consumer price index that show us what? Consumer price index, you can find out the details right here when you scroll it down, is overall inflation indication. But before all of this takes place, retail sales, CPI, you got to know what are the producers doing. You don't think the producers are oblivious, or you think producers are aware? Well, Apple, you heard the whole story in the media. You know what are they doing with the production of the latest iPhone? Well, we're gonna cut down the things and all this. So they don't want to have their iPhone sitting stocked up as inventory. So why would anybody care about the price producer index? Because it's a leading indicator. So be ready for the hellstorm on Wednesday, on Thursday, and on Friday. So Wednesday is the PPI. Thursday is coincidentally consumer price, and of course the real reality kicks in when the retail sales showed up. So the Amazon might not have their best Christmas ever when people are spending $7 in California per gallon on a gas station, and it might revisit this 100 level because it has been there already before. So this little pop to the upside is just fill the gap. It's nothing. It's nothing major. So what do we do next? We know that volatility is high. So we are then sellers because it makes more sense to be a seller. So we did the bear call spread. What about the bull put spread? Could we do the bull spreads? Yeah, and then got run over. That little capital that you get from a premium to bull put spread, it's not worth when you get run over. So instead of doing the bear call spread and a bull put spread, which spell out IC or the iron condor, what we have done, we have created what I like to call, this is just me. So don't use this now in a cocktail party, because they won't even know what it is because I I don't want to say I invented the term. The term is out there. It's just how many people actually know that term. It's a double bearish vertical. And that means that I'm financing my bear put that is completely out of the money with the two of the bear call spreads. So thank you once again. Please stay hedged and be aware of it. Wednesday, there's going to be a gap. Yeah, we don't know which way it's going to be a gap, but there's going to be a gap. Thursday, there's a high chance it's going to be gap because that is a red flag event. And retail sales are going to also go to gap. So I would suggest be hedged and all the best. Bye bye.